Foreign exchange, or Forex, is the largest financial market in the world. It trades 24 hours a day, around the clock, across all time zones. Now, if you've ever looked at a currency chart, rates can swing wildly within minutes or even seconds. Such volatility is actually, to some extent, predictable. Why? Well, because large volatility spikes are expected when politicians make announcements, or when economic indicators are revealed, or when central banks make interest rate decisions. Where does this volatility come from? Well, ultimately it's coming from market activity in the form of quote updates by dealers or actual trades by hedgers or speculators. There are everyday so-called currency fixes, which are preset times when banks aggregate bids and offers to publish official benchmark exchange rates. These rates serve as reference points for trillions of dollars of international transactions, from corporate hedging to portfolio valuations. In this project, we studied the fixes and detected a clear pattern in predictable price movements in the US dollar. Every day at precisely 9:55 a.m. local time in Tokyo, 2:15 p.m. local time in Frankfurt, and 4 p.m. local time in London, the dollar appreciates into the fixes, only to revert and subsequently depreciate post-fixing. In terms of the economic size, we estimate that patterns we detect imply swings exceeding $1 billion per day. We found a daily swing at key times called fixings. This is the official time when the benchmark exchange rates are published as references for international transactions. The Tokyo fixing sets the pace for Asian markets, the Frankfurt fixing caters to European trading hours, and the London fixing has historically been the most influential. In the New York time zone, which is the Eastern time zone, the Tokyo fix occurs at 8:55 p.m, Frankfurt at 8:15 a.m, and London at 11 a.m. We argue that the around-the-clock W-shaped price pattern reflects the US dominance as the preferred currency for global payments. In local morning times before the fixes, huge predictable demand for dollars from corporations, which is ultimately executed by FX dealers, pushes up the price of US dollars. After US dollars are bought and sold, the market clears, and right after the fixing, the US dollars are sold back, leading to a price reversal. There are many risks invested in currency markets, but one popular strategy is the so-called carry trade. This is a trade in which you borrow in low interest rate currencies, such as the Japanese yen, and invest in high interest rate currencies, such as the Australian dollar. According to the classic uncovered interest rate parity theory, this strategy shouldn't earn any profits because the high interest rate currencies, well, their spot rate should depreciate to offset interest rate differentials. However, in reality, this doesn't happen, and carry has been a highly profitable trade for decades. In follow-up research with the same co-authors, we are studying UIP violations and the carry trade in high frequency. Our main finding is that even though central bank and major economic announcements account for around 17% of all trading days, they generate 62% or 2/3 of the traditional carry trade's excess returns. So our finding is consistent with an old saying. The carry trade is akin to picking up nickels in front of steamrollers. You earn small, predictable profits until suddenly market volatility wipes you out. If you would like to find out more about our research, please visit China Business Knowledge at CUHK.